Welcome to the Academy Introduction to Bonds, also known as fixed income. In this video, we'll look at what bonds are, their main benefits, and how they're traded. A bond is a debt investment product in which an investor loans money to a borrower for a defined period of time at a certain interest rate, where the interest is paid at predefined intervals. Bonds are typically issued in sizes of 250 million euros and $250 million and above. The issue size is also known as the principal amount. A typical bond is issued as a bullet-type loan. A bullet-type loan is characterised by paying interest at predefined intervals. These interest payments are also known as coupon payments. When the bond matures, the principal amount is paid back to the investor. The coupon on the bond is the interest that you receive on the nominal value of the bond. This is not to be confused with the yield to maturity, which expresses the effective amount of interest you'll receive on the bond if you hold it to maturity. Bonds can be traded in two ways, either via an exchange or OTC, which stands for over-the-counter. Government bonds issued in local currency are typically traded on exchanges, but the majority of bonds are traded OTC. In the rest of this video and in the education material in general, we'll be concentrating on OTC traded bonds. Borrowers are typically governments, such as Germany or Brazil, municipalities, such as the city of Buenos Aires, corporations, such as Volkswagen or Petrobras, and banks, such as Citigroup or Deutsche Bank. The major difference between government bonds, also known as sovereigns, and other bonds is that they are typically recognised as the most secure bond issued in the country that they represent. This is due to the fact that a sovereign has the privilege of collecting tax. So the coupons and principal payments are secured by the tax revenue collected, and the risk is related to the entire country. In rare cases, however, you can observe the opposite. So how are bonds traded? Well, let's imagine that X corporation wants to borrow money in order to fund its expansion plans. It issues a $250 million bond that has a 10% coupon and a 5-year maturity. Typically, a consortium of banks would buy the bond. So together they would pay X corporation the $250 million that it wants for its bond. The bond would be divided into units with a nominal value of $100,000 each. A unit with a nominal value of $100,000 is therefore the minimum trade size of the bond, and the banks can offer these units for sale to investors. But the bond still needs a price. Initially, the consortium of banks will contact potential investors who then buy the bond at issuance, typically at a price of 100, also known as par. In other words, for each $100,000 that an investor buys of the bond, he'll receive a unit of the bond with a nominal value of $100,000. As you can see, the price of a bond expresses the amount that you have to pay for a unit with a nominal value of 100. So in order to calculate the amount that you will need to pay for the bond, you will always take the price of the bond, divide it by 100, and then multiply it by the nominal amount that you're purchasing. Something else that you should know about the bond is that it has a coupon of 10% annually. This means that once a year, you'll receive an interest payment that is 10% of the original $100,000 lot size. $10,000 in other words. And if you hold the bond to its maturity, which is 5 years after it was issued, you'll also get back the principal amount of the bond, which will be $100,000 if you bought one unit. Like other financial products, bonds are traded at a price spread. The price spread expresses the difference between the bid, the price you can sell at, and the offer, the price you can buy at. The size of the price spread on a bond is dependent on several parameters, the most common being the credit rating of the bond and the market liquidity of the bond, which is the ability to convert the bond to cash quickly. The credit quality of an issuer is normally expressed by a credit rating awarded by one or more of the rating agencies. The three major rating agencies are Standard & Poor's, also known as S&P, Moody's and Fitch. Bonds can be divided into two main rating categories, investment grade and high yield, with investment grade bonds having the best ratings. The credit quality is a determining factor when pricing a bond. The higher the quality, the higher the price, and the lower the yield to maturity. As we mentioned earlier, you trade a bond at a price. On top of this, you also pay or receive accrued interest. When you buy a bond, you pay accrued interest, and when you sell a bond, you receive accrued interest. Accrued interest is the interest that's accumulated on the bond since the last coupon payment. As it's always the holder of the bond that receives interest at the time of the coupon payment, you need to modify the payment of a bond to allow for the accrued interest if the trade is done between coupon dates. If you sell a bond, you need to be compensated for the interest that the bond has earned since last coupon date by the buyer, since it's the buyer who will receive the full coupon amount on coupon day. In a moment, we'll show you an example of how this is calculated. As coupon payments are dependent on the interest calculation method, you'll need to know the specifics of the bond that you're trading before you can calculate the exact value of the coupon payment. Typically, most bonds are issued with an interest calculation convention called actual, which means that the number of days used for calculation in any given coupon period is the actual number of days in that period. Let's look at an example. We have a bond with a coupon of 5%, which is paid annually on February the 15th. You now want to buy that bond, with the settlement date of the trade being August the 15th. The settlement day is typically 2 or 3 days after the day you trade. Assume that there are no leap days, so it's a 365-day year. The number of days that have passed since the last coupon payments is 181. This is the number of days from February the 15th to August the 15th. Finally, you want to buy for a nominal 100,000 euros. The accrued interest calculation looks like this. 5% of 100,000 euros multiplied by 181 and divided by 365. This gives an amount equal to 2,479.45 euros, which you, as a buyer, pay the seller of the bond. On top of this, you will of course also pay the price of the bond. Now, using the earlier example, let's assume the price is 105. So the amount you need to pay consists of two elements. A, the price. 105 divided by 100 and multiplied by 100,000 euros equals 105,000 euros. And B, the accrued interest, which is the 2,479.45 euros we just calculated. So in total, you pay 107,479.45 euros. Investors buy bonds for various reasons, but let's look at two of the most common benefits of buying them. Bonds can be used as an alternative to stocks, where a company issues both bonds and stocks. The benefit of buying a bond compared to a stock is that you get a more predictable cash flow, known coupons versus unknown dividends, and you preserve your capital. You know the amount you'll receive when the bond matures, whereas the cash you receive from selling a stock will depend solely on the price of the stock at the time you sell it. Another strategy is the yield pickup strategy, where the investor aims at getting a better rate of return on their investment by moving from bonds issued by governments into bonds issued by corporations, but without giving up too much creditworthiness. This strategy entails the investor buying investment-grade bonds, which have a high credit rating.